Thank you, Wally. I want to thank Wally and Joni for scheduling this meeting at such an appropriate time. I mean, forecasting the economy is hard enough as it is. I like to try and do it when conditions are so calm. I mean, think about it, 2016. There's no political issues we're going to be facing. Right now, the world economy is in just incredible shape. The stock markets are moving just the way we expected them to do. So everything's so nice and calm. That was a joke, people. I mean, seriously. This is one of the more fascinating and interesting times that we have. And giving you a forecast of what's going on and really ultimately what it means for the industry is what I'd like to talk about in the next few minutes. And let me start off by simply saying I have good news and I have bad news, okay? And being an economist, that's like having a right hand and a left, a right hand and a left hand, one or the other. But let me start with the good news. The good news is that I'm really optimistic about 2016. Now, I was optimistic last year, and the economy was reasonably good. It wasn't spectacular. What I failed to forecast was oil prices below $40 a gallon, which really did crater the energy sector and associated industries. But other than that, the domestic economy did reasonably well in 2015, and it's likely to do well in 2016. The question is, how can I be optimistic? And indeed, my expectation is we'll do better this year than we did last year. Given that, as we all know by now, the stock market started off this year worse than it has in the last 100 years. I mean, the declines have been enormous. It's bounced around, but it's gone down nearly double digits. Some of the indices are down double digits. We have fears about China. Is this economy beginning to really falter? We have the price of oil that was below $30, let alone $40, below $30 at this particular point. So how in the world can I make the comment that we're going to have a good year this year? And it's simple. Let's take a look at the details rather than take a look at the headlines. And when you're looking at the economy, it's most important to understand really the details of things. First of all, you got to recognize that every once in a while, not all the time, but every once in a while, Wall Street and Main Street exist in parallel universes. They are just someplace else. Wall Street is operating as if things are either great or terrible, and Main Street is just doing its own thing, which is totally separate. And that's the case right now. While we all worry about the headlines that the stock market's down 400 or 500 points, the question we have to ask is why that's happening, and does that really have some fundamental implications for the economy? And so let's take a look at what's happening as far as the equity markets are concerned, and why I tend to discount it to a large extent. One of the chief concerns about the equity markets is China. China is slowing. Well, there's a realism here that we have to understand. The Chinese data have never been particularly honest. I mean, let's face it. For years, I've been going around saying to people, if you believe the numbers coming out of China, I've got a bridge for sale. And if you're not in the market for a bridge, I'm producing this play on Broadway. And you can have any share of it you want, or as much as you want. The reality is that if you just think about collecting data in an economy like China, it's almost impossible. Yet you see the data, they go up smoothly, they come down smoothly. U.S. economic growth, you have percent growth one quarter, 0.5% the next quarter. In China, it's 6.5%, and then when things get bad, it's 6.4%. And it gets really bad, it goes down to 6.2%. I mean, these are the kinds of change, it makes no sense. But much more importantly, even if the Chinese economy is slowing, recognize something, that China is not that important to the US as far as the domestic economy is concerned. Our exports to China constitute exactly 0.7% of GDP. If we lost 10% of our exports to China, it would mean our GDP would decline by 0.07%. That's not even a rounding error when you estimate GDP. We don't export that much to them. Yes, it's a concern. Where's the concern? Businesses that earn a lot of their revenues by doing business in China, producing in China, selling in China, and so on, they'll see their earnings decline. When they see their earnings decline, what happens to their stocks? Earnings go down, their equity prices go down. So the Chinese slowdown doesn't really affect the US economy in terms of exports a whole lot, but boy does it affect a lot of companies in terms of their earnings. So you got to separate the earnings part, which is Wall Street, from Main Street, which is the export side, and it's not going to affect the domestic economy that much. The second thing that's hurting Wall Street and equity prices is the strong dollar. Well, the strong dollar could slow our exports a little bit, but they haven't slowed a whole lot so far. But it's much more important for equity prices. Why is that the case? Well, if you earn some money in a foreign country and the value of the dollar goes up and you try and take that money and turn it into dollars, you get fewer dollars. In other words, it's an accounting issue. It's not an economic issue. So in terms of China and the dollar, it's not a big issue for the domestic economy. The last thing that's been hurting the equity markets has been the low price of oil. And what has happened is that while roughly $125 to $150 billion has remained in household pockets because of that, and businesses have had to pay less in terms of utilities to the tune of tens of billions of dollars, the energy sector has reacted dramatically. They've quickly cut back all of their investments. The firms that are associated with them have lost sales, whether it's goods, services, machinery, equipment. So we've seen a very sharp cutback in the sector and their associated firms, and that's affect business earnings and stock prices. But you've got to ask this question: which would you rather have in the long term? An economy that has $2 a gallon for gasoline, or an economy that has $4 a gallon for gasoline? Most people and most economists will look at the $2 a gallon as being the more desirable because that money is spread further across the economy. So what you have is Wall Street getting battered, and it may continue to get battered. I don't know what's going to happen to the price of oil. I've seen estimates for December anywhere from $20 a barrel to $60 a barrel. So you can assume that at the end of this year, the price of oil will be anywhere from $20 to $60. I don't know. But the reality is that we're in good shape. And where we're going to get the strength from is the bad news. Last year when I was here, I think if you remember, I warned you of the coming labor shortages and the issues we have to deal with in terms of labor shortages. Well, if you're having problems now, wait a year. It's going to be an awful lot worse. And that is really the foundation for the economy. We're growing at a pace that's going to reduce the unemployment rate by the end of this year to 4.5% or less. That means there's going to be industries, occupations, regions in this country that have unemployment rates below 4%, and some of them at as low as 3% or even less. Those are labor shortages issues. There's no question about it. So what that means is that while we haven't seen a significant increase in wages, we've begun to see that happening already in the economy. For example, in 2013, between December 2012 and 2013, hourly wages in the economy grew by 0.5%. In 2014, they grew by 1.5%. In 2015, they grew by 2.5%. I think that kind of shows that there's a trend going on. And we haven't even got to the point where there's major labor market shortages in this country, and they're coming. So what that says is that wages are going to be going up. Income growth is likely to accelerate. With the jobs being created, total income in the economy will improve. U.S. economy is 2/3 the consumer. They finally have the income coming in, they will spend it. That will be the key to driving the economy. When businesses outside of the energy sector start seeing that demand continuing to grow, even now, if you take out the energy sector, investment is expanding. That'll expand even more. Even state and local governments are spending more. Everything is coming together for a better economy, driven in no small extent by the tightening of the labor markets, the rising of wages. Okay? So the outlook for this economy is that we're going to grow this year. We grew in 2015 by about 2.25%. We don't quite have the fourth quarter numbers yet, but roughly that. That's trend growth. That's the economy's potential, so we're growing at potential. This year, the forecasts of most of the panels that I'm on range from about 2.5% to 3%. So we're going to grow solidly, if not strongly, over this year. And that means that unemployment rate is indeed going to come down. But what that means, of course, is that we've clearly begun to move into a point where we no longer can dismiss the idea that we will not be able to find workers that we need. Already, if you take a look at the data, on a national level, job openings are the highest it's ever been. The rate of job openings is growing. The ability to find jobs to find workers is going down. And maybe most importantly is the quit rate. The number of people who are willing to actually leave their jobs. That is moving up. It's not quite to where it was 10 years ago, but it is way above where it was at the worst times in the recession and the recovery 4, 5, 6 years ago. And that shows how strong conditions are changing. So what you have on one side, as we face 2016 in this industry, is a situation, at least on the cost side, where it's going to be even tougher to find workers. We're going to see turnover rates, which have been likely to rise even more. We're going to see the quit rates begin, but that is going to imply higher costs to us in retention costs, whether that's through benefits or through wages or the combination of the two of them. On the other hand, where you can be optimistic about the industry is the fact that incomes are growing, and they're likely to continue growing even more strongly. And if you add to that the fact that consumers and households are slowly but steadily using that $150 billion that they've gotten in 2015 from the low price of energy, and probably another $100 to $150 billion that they'll pick up in terms of continued low price of energy. Even if it goes back to $40 or $45 a barrel, we're going to get something in the range of $100 billion back into households' pockets. You have a situation where households are willing to spend. Now, will the equity market decline hurt confidence? Not necessarily. That's really the only negative that I really worry about. But I think January is a great example. As I said, the first couple of weeks of this year were the worst we've seen for the equity markets in 100 years. Yet, at the end of last week, we got the first reading of consumer confidence for the first half of 2016. Consumer confidence has actually gone up despite the decline in the equity markets. People are no longer as in tune. They don't look at their 401ks every day anymore. They're not as worried about the markets. They've learned markets go up, markets go down. You've got to be a little patient. So my forecast is we're likely to have a better economy. Growth should pick up, but we're going to be pressured by the tightening of the labor markets. And while that may cause wages to rise, it's also going to cause demand to rise. So in that respect, I'm really confident, not just about the economy, but the opportunities that the economy presents for the restaurant industry in 2016. Thank you.